Welcome to the deep dive. We try to cut straight to the knowledge you're looking for.
Yep, get right into it.
And today we're digging into a trading strategy that's, well, it's generating some buzz. It's the Quantified Strategies RSI strategy.
Right, the one with that reported 91% win rate in back tests, that's pretty eye-catching.
Exactly. So let's see what makes this thing tick.
Well, what's interesting, I think, is its simplicity. We're not talking complex, long-haul investments here. This is all about spotting short-term opportunities. And our sources, they look at how this strategy, which was tested on the S&P 500, the SPY ETF,
Right.
how that might potentially work for the Nifty 50, the main Indian index.
Yeah. And the core idea seems to be catching those quick price snaps, those reversals. Like if the market drops fast, it often bounces back a little, doesn't it? This strategy tries to nail those moments.
And it uses a very specific tool for that.
The RSI, but a really short-term one.
Exactly. A 2-day relative strength index, the RSI.
2 days. That sounds incredibly sensitive.
It is. Unlike, say, the standard 14-day RSI, which smooths things out over a couple of weeks, this 2-day window makes it hyper-reactive, almost instant price action feedback.
Okay.
So when it dips really low, like below 15, the thinking is the market might be oversold, probably due for a quick bounce.
And the opposite for highs.
Yeah, if it spikes above 85, that suggests things might be overbought, maybe overheated, and could pull back. It's mean reversion, basically.
So betting things will swing back towards the average, not stay at extremes. Got it.
Now, practically speaking, how would someone listening try this on the Nifty 50?
It's fairly straightforward, actually. You'd use a daily Nifty chart,
Okay.
and you watch that 2-day RSI. The trigger to buy comes if the RSI closes below 15 on any given day.
So, if RSI 15 at close.
You buy at the market open the next day. Think back to maybe the Nifty's correction on October 2024 if you saw a sharp drop, push that 2-day RSI under 15. This strategy says, okay, buy the next morning.
Right, and getting out. When do you take the profit, assuming there is one? The exit rule is just as clear. You sell at the closing price on the day the 2-day RSI climbs back up and closes above 85.
Okay, so the overbought signal.
Exactly. So if the Nifty bounces after that hypothetical dip and the RSI eventually pushes past 85,
You sell at the end of that day.
correct. End of day close. And typically, you're only in the trade for, well, maybe 2 to 5 days. It's quick.
Very short term.
Yeah.
Okay, but with fast moves like that, losses can happen fast too. How do you manage the risk?
Oh, absolutely critical. Risk management is paramount here.
Yeah.
First, a stop loss. It's really recommended.
Where would you set it?
Maybe 2%, perhaps 3% below your entry price. That caps your potential loss if that bounce just doesn't materialize or if it reverses again.
Makes sense. Anything else?
Position sizing, definitely. Don't bet the farm. The sources suggest maybe allocating only a smaller part of your capital, say around 10% per trade.
Right, spread the risk.
And maybe be cautious around really big news events. They can cause wild swings that might blow past your stops.
Good point. Now, our sources actually ran a simulation, didn't they, on the Nifty for a period?
It did, yeah. A simulated backtest between January 2024 and March 2025.
And what did that show? Did it match the SPY's 91%?
Well, it's interesting. In that specific, fairly short window, which did have some volatile patches, the strategy actually produced a profit. Modest, about 0.46% on the capital used across 3 trades it triggered.
And the win rate in that small sample?
It was 100% for those 3 trades. But remember, the 91% figure comes from a much larger SPY backtest.
So you should still expect some losses.
Definitely. Occasional losses are part of the game, even with high win rate strategies. And it's worth noting, just buying and holding the Nifty during that same period would have actually resulted in significantly higher gains.
Ah, okay. So potentially less profit than buy and hold, but maybe more consistent small wins. Why might it still be considered for Nifty?
Well, connecting it to how the Nifty sometimes behaves, it does often have these quite sharp, quick bounces after steep drops.
Right, I've seen that.
So that oversold RSI signal, the below 15 rating, could potentially be a decent entry point for those bounces. And, while the SPY results aren't a direct guarantee for Nifty, that high win rate over there does offer some level of, let's say, encouragement.
Well, it's a short holding period you mentioned.
Exactly. Limits your exposure if the market decides to keep heading south for longer.
But there have to be catches, right?
Okay.
What are the big caveats here?
Oh, for sure. A key one is that these signals, RSI below 15 or above 85, they're actually quite rare.
So not many trading opportunities.
Potentially, yes. You might be waiting a while for a signal.
Huh?
And there's always the risk, the main risk, really, that the Nifty just keeps falling after you buy based on that 15 signal.
Hence the stop loss.
Absolutely crucial. And don't forget, trading costs, commissions, fees, they can add up if you're trading more frequently, even if it's only occasionally frequent.
Right. And maybe not great in flat markets.
Probably not. If the market is just drifting sideways without strong pushes up or down, you likely won't get many or any of these extreme RSI signals.
Okay, so it demands patience, discipline, and strict risk control. For listeners who are intrigued and want to look into this more, what's the next step?
Well, a good starting point is just to look. Pull up a Nifty 50 chart on, say, TradingView or whatever charting tool your broker provides.
And add the 2-day RSI indicator.
Exactly. Just observe it. See how it behaves, especially during past dips and rallies. Get a feel for it.
And maybe try it without real money first.
Definitely recommend paper trading. Practice the entries and exits with virtual money in real-time market conditions. No risk, lots of learning.
Good idea.
You could also just do some research online. Look up 2-day RSI trading strategies for more context. And maybe a slightly more advanced tip.
Oh,
Consider the bigger picture. Maybe look at the longer-term trend, like using a 200-day moving average. Perhaps only take buy signals if the Nifty is generally above its 200-day average, for instance, as a kind of filter.
interesting. So layer on another condition. Okay, wrapping this up then. Our deep dive suggests this quantified strategies RSI approach is a very short-term mean reversion play. High reported win rate on the SPY, potential application to Nifty explored.
But with key considerations.
Absolutely. Strong risk management is non-negotiable, and as always, do your own homework, your own testing.
Which leads us nicely to a final thought for you, the listener. We know the SPY and the Nifty 50 are different beasts, different market structures, participant behaviors, volatility patterns. So considering those differences, what other factors, beyond what we've discussed, do you think might really impact how this short-term RSI strategy actually performs in the real world,
Yeah.
specifically in the Indian market? Something to think about.